Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. This week we're covering the period from March 8th through March 15th, 2026. And frankly, it was a brutal week for most aviation stocks.
That's putting it mildly, Mike. When your top gainer for the week is up just 0.25%, you know it's been rough out there. But before we dive into the carnage, what's your overall take on what we witnessed this week?
Sarah, this was one of those weeks that really separates the strong operators from the vulnerable ones. We saw widespread selling pressure across the airline sector, with some carriers getting hit particularly hard. Alaska Air Group led the decline at negative 10.61%, followed closely by Southwest at negative 9.88%, and American at negative 9.25%.
Those are some serious moves. And it wasn't just the airlines. We saw weakness across most of the aviation ecosystem, didn't we?
Absolutely. General Electric dropped 7.41%, Boeing fell 4.37%, and even the typically resilient cargo carriers took a hit. FedEx was down 3.64%, UPS declined 4.57%. The only bright spot, if you can call it that, was Raytheon Technologies, managing a modest 0.25% gain.
Let's talk about the market structure here. What matters is that we're seeing a fundamental shift in how investors are viewing aviation risk right now. The fact that 10 of our 11 tracked airlines moved lower, with most posting mid to high single-digit declines, suggests this wasn't company-specific news driving the moves.
That's exactly right, Sarah. The common pressure behind this coordinated move was broader sector concerns around supply chain constraints and demand sustainability, themes that came through clearly in this week's aerospace industry coverage. When you see Alaska, Southwest, American, JetBlue, and Allegiant all down between 6 and 11%, that's systematic selling pressure.
Now, let's establish our narrative framework for the week. Mike, what would you say was the overarching story?
This week's narrative was supply chain fragility meeting demand uncertainty, creating a perfect storm for aviation equity valuations. Operationally, this means carriers are facing continued pressure on aircraft deliveries, while simultaneously dealing with questions about their ability to maintain pricing power in a potentially softening demand environment. For investors, this translates to heightened focus on balance sheet strength and operational flexibility, rather than growth metrics.
That's a great framework, and it really explains why we saw such broad-based weakness. Now, let's pivot to our top gainer spotlight, which feels a bit ironic given the circumstances. Raytheon Technologies managed to eke out a 0.25% gain to close at $204.52. Mike, what's keeping RTX resilient while the rest of the sector struggles?
It's a fascinating contrast, Sarah. RTX operates in a fundamentally different part of the aviation ecosystem than the airlines. While carriers are dealing with consumer demand volatility and operational challenges, Raytheon's aerospace business is largely tied to defense spending and long-term commercial aerospace contracts that provide more predictable revenue streams.
Walk me through what that means from a business model perspective.
Sure. RTX has three main segments: Collins Aerospace, Pratt & Whitney, and Raytheon Intelligence and Space. The defense portions of their business operate on multi-year contracts with governments, which provides revenue stability even when commercial aviation faces headwinds. Meanwhile, their commercial aerospace exposure through Collins and Pratt is more on the OEM side rather than the airline operating side.
So they're somewhat insulated from the immediate pressures hitting the airlines?
Exactly. When airlines struggle with demand or operational issues, that doesn't immediately impact RTX's existing engine maintenance contracts or avionics supply agreements. In fact, if airlines are keeping older aircraft in service longer due to delivery delays, that could actually benefit RTX's aftermarket services business.
That's an interesting dynamic. And given the supply chain issues we're hearing about across aerospace, RTX's position as a critical supplier probably gives them some pricing power as well.
Absolutely, Sarah. They're essentially a toll booth in the aerospace ecosystem. Airlines need their engines serviced, aircraft need their avionics systems, and there aren't many alternatives at RTX's scale and capability level. That creates a much more defensive business model compared to the airlines, which are price takers in both their input costs and their revenue generation.
The 0.25% gain might seem modest, but in the context of this week's sector performance, it's actually quite impressive. Let's shift gears now and talk about SEC filings. We had 5 filings this week, though unfortunately we don't have parsed content for detailed analysis. What can you tell us about the filing activity?
We saw some notable 8K filings that are worth watching. Southwest filed an 8K on March 12th, American filed one on March 9th, and FedEx submitted an 8K on March 12th as well. While we don't have the specific content, the timing is interesting given the stock performance we witnessed.
What should investors be reading into the timing of these filings relative to the stock moves?
Well, 8K filings are typically for material events or corporate changes that companies are required to disclose promptly. The fact that Southwest and American both filed 8Ks during a week when they were among the worst performers in our coverage universe suggests there may have been specific company developments beyond just general sector weakness.
And what about the General Dynamics filings? They had 2 Form 4s on March 11th and 13th.
Form 4s are insider trading reports, so those indicate executive or director transactions in GD stock. Given that General Dynamics closed down 2.42% for the week at $351.52, it would be interesting to see whether those were insider purchases during the weakness or routine sales. The timing of having 2 filings just 2 days apart suggests some level of coordinated activity.
This week's filings reinforced prior themes rather than introducing new structural shifts, but the concentration of 8K activity among the underperformers is something we'll want to monitor as more details become available.
Absolutely. And investors should remember that 8K filings can range from routine operational updates to significant strategic announcements. Without the content, we can't draw definitive conclusions, but the pattern is worth noting.
Let's move into our news roundup now. We had some significant coverage this week that helps explain the sector weakness. The headline that caught my attention was about takeaways from the Aerospace Event 2026, particularly the mention of soaring demand meeting a fragile supply chain.
That story really encapsulates the contradiction facing the aviation sector right now, Sarah. On one hand, industry participants are talking about robust demand for air travel and aircraft. On the other hand, the supply chain issues that have plagued aerospace for the past several years are far from resolved.
How does that dynamic play out for different parts of the aviation ecosystem?
It's actually quite complex. For airlines, strong demand should theoretically be good news because it suggests pricing power and load factor support. But if they can't get the aircraft they need to serve that demand, or if supply chain issues drive up their maintenance and operational costs, the strong demand becomes almost a tease.
And we also saw coverage of Middle East conflict impacts on Airbus and Boeing. That adds another layer of complexity to the supply chain story.
Exactly. Geopolitical tensions create additional uncertainty in what's already a fragile global supply network. Both Airbus and Boeing have suppliers and operations spread across multiple regions, so any disruption to trade flows or manufacturing partnerships can ripple through their production schedules.
The third story that stood out was about supply chain improvements, but with the ominous note that the light at the end of the tunnel could be a train. That's not exactly the optimistic recovery narrative the sector needs.
That headline perfectly captures the mood in aerospace right now. Industry participants are seeing some incremental improvements in supply chain metrics, but there's deep skepticism about whether these improvements are sustainable or whether new challenges are just around the corner.
What kind of new challenges are we talking about?
Well, it could be anything from labor shortages at key suppliers to raw material cost inflation to additional regulatory changes following safety incidents. The aerospace supply chain is so complex and interdependent that problems in one area can quickly cascade to others.
Speaking of safety and regulation, we also saw news about NTSB board member J. Todd Inman's abrupt departure from the safety watchdog. How significant is that for the broader sector?
Personnel changes at the NTSB don't typically move markets directly, but they can signal shifts in regulatory priorities or internal tensions around safety oversight. Given that aviation safety remains a critical concern for both regulators and investors, any instability in the oversight framework gets attention.
These news themes really tie together, don't they? Supply chain fragility, geopolitical risks, regulatory uncertainty. It's creating a perfect storm of investor anxiety.
That's exactly right, Sarah. And it explains why we saw such broad-based selling this week rather than company-specific moves. When investors are worried about systematic risks to the entire sector, they tend to sell first and ask questions later.
Now, let's dive deeper into our top loser analysis. Alaska Air Group had a particularly brutal week, falling 10.61% to close at $38.00. Mike, what's behind this significant underperformance?
Alaska's decline is especially notable because they've historically been viewed as one of the better managed carriers in the industry. A 10+% weekly decline suggests either company-specific concerns or that investors are particularly worried about Alaska's specific exposure to current sector headwinds.
What makes Alaska potentially more vulnerable than some of their peers?
A few factors come to mind, Sarah. Alaska operates a significant amount of capacity in markets that might be more sensitive to economic uncertainty. They have substantial exposure to leisure travel, particularly to and from Alaska itself, which is often more discretionary spending for travelers.
And their route network is pretty concentrated geographically compared to the big legacy carriers, right?
Exactly. While Alaska has grown significantly through acquisitions like Virgin America, they're still much more regionally concentrated than a United or Delta. That concentration can be a strength when their markets are performing well, but it becomes a vulnerability when investors are worried about regional economic weakness or demand shifts.
Are there operational factors that might be weighing on Alaska specifically?
Fleet and operational complexity could be playing a role. Alaska has been integrating different aircraft types and route systems from their acquisitions, and supply chain issues in aerospace hit smaller carriers differently than the major carriers. The big airlines have more leverage with suppliers and more operational flexibility to work around delays or parts shortages.
The 10.61% decline puts Alaska's stock at $38, which seems like a significant technical level as well.
Absolutely. When you see a stock break through key support levels on high volume, it can trigger additional selling from technical traders and momentum algorithms, which can amplify fundamental concerns. Alaska's decline was steep enough to potentially trigger some of these technical selling programs.
Looking ahead, what should Alaska investors be watching for to gauge whether this weakness is overdone or if there are deeper issues at play?
I'd be watching for any guidance updates or operational metrics in their next earnings report or investor updates. If this is just caught up in sector-wide selling, Alaska's operational performance should remain relatively stable. But if we start seeing company-specific issues with load factors, yield management, or operational disruptions, that would validate the market's current pessimism.
Let's look ahead to next week now. What are the key things investors should be monitoring?
First, I'd watch for any additional 8K filings or investor communications from the carriers that got hit hardest this week: Southwest, American, and Alaska in particular. If there were specific company issues driving the weakness, we should get more clarity soon.
What about broader sector catalysts?
Any updates from the ongoing aerospace conferences or industry events could provide more color on the supply chain situation. We're also moving deeper into the spring travel booking season, so any data points on demand trends or pricing power would be valuable.
And given the geopolitical concerns mentioned in this week's news coverage, presumably any developments in global trade or conflict situations could impact sentiment.
Absolutely, Sarah. The aerospace sector is particularly sensitive to international trade disruptions given the global nature of both supply chains and end markets. Investors will be watching for any escalation or de-escalation of tensions that could affect manufacturing or demand patterns.
From a technical perspective, are there key levels to watch after this week's decline?
Most of the airline stocks are now testing or have broken below important support levels. If we see continued weakness early next week, we could get some momentum-driven selling that pushes stocks even lower in the near term. Conversely, if we get any positive sector news or broader market recovery, these stocks could see significant relief rallies given how oversold they've become.
This week suggests investors are prioritizing balance sheet strength over growth potential, signaling that defensive positioning is taking precedence as supply chain and demand uncertainties create a more challenging operating environment for aviation companies.
That's an excellent synthesis, Sarah. We're definitely seeing a flight to quality within the sector, which explains why RTX held up better than the airlines and why some carriers got hit harder than others.
Before we wrap up, let's make sure our listeners understand that this analysis is for informational purposes only and should not be considered investment advice. Always consult with a qualified financial professional before making investment decisions.
Absolutely. And remember that aviation stocks can be particularly volatile, so any investment decisions should be made with appropriate risk management and diversification in mind.
That's a wrap for this week's Aviation Intelligence Weekly. I'm Sarah.
And I'm Mike. Thanks for listening, and we'll see you next week for another deep dive into aviation market intelligence.
Until next time, keep your analysis grounded and your perspective elevated.